This is the Daily Market Rundown live from the Tradelo trading floor. It's March the 4th. Some highlights from today's show. Surprise tariffs hit the market, Eurodollar is now primed to rally, and Fed rate cut bets are now in play. Good day traders, and welcome. Quite a lot to get through, so let's get stuck straight into it. There's a lot of volatility in the markets. It doesn't matter what you call the market. Across the board we see it, whether it's the commodities, whether it's the currencies, whether it's the bonds or the equities. There is volatility across the board, and it's coming from ultimately what we heard yesterday in a number of different forms. And we're going to start off and talk a little bit about the implications for markets. Now, if we go across and take a look, the key takeaways yesterday was, of course, we had the tariff announcements on Mexico and China and Canada. Those have come into play now effectively. We've had retaliatory measures from pretty much all three countries, barring Mexico. Of course, they are due to say something today. At the same time, we had OPEC sort of being forced into a corner to, talk about increasing supply. Now, whether or not they do that is not as important as ultimately the direction of play, which is seemingly Trump is pressurizing the Middle Eastern OPEC countries to increase that supply and bring down those inflationary pressures. We then, of course, also have the EU in play now, talking about some significant spending plans on defense coming across the board. And all of this together is culminating in a lot of repricing in a number of different markets. Okay, now for us as traders, when there is this sort of volatility, we need to lock onto it. It's very, very good opportunistically. And let's start off and talk a little bit about some of the key markets getting hit. And I think the key takeaway, and you can see it in the sort of the rundown of the equities, is look at the Mag 7. Okay, and this is supposed to be, if you go back a year and a half ago, there was this sort of thinking on Wall Street that the Mag 7 are equivalent to sort of A-rated type bonds, in that you get a capital gain out of them, you get a small yield out of them, and effectively they are just golden names to hold. Now, in a day like yesterday, we can see how that pretty much all comes unstuck across the board. And of course, we've been talking a lot about Nvidia. I mean, look where that's trading, back at that 114 level. That is effectively the deep seek lows. A day like yesterday where we're down, 8.5% is very, very significant in terms of sentiment. Now, importantly, sentiment doesn't just shift. Okay, sentiment doesn't just switch. We don't just go from, oh, it's the end of the world type stuff to, oh, happy days. It doesn't work that way. And so I suspect now, with the VIX sitting up at 22s, it is very much a case of sentiment is going to remain very, very negative until we get something that shifts it. And I don't think that something comes anytime soon. Now, we can see that sentiment on the VIX, and I think there's something very, very important to stress in this VIX. One, note where we're trading. Okay, if you look at the daily candles, what you can see is we've been bumping up this series of higher lows the whole way up. We've effectively not closed below a previous day's low in six, 7 sessions now. And this shows a pressurized situation in which eventually the market is going to be forced to start hedging in the outright. What do we mean by that? Well, as the implied vol becomes very, very high, effectively options become very expensive to use as a hedging tool. Now, ultimately, what eventually happens is the market forces participants that want to hedge into the outright market. In other words, instead of being able to hedge and pay a very, very expensive premium, what we typically see is quite an unwinding of certain positions. And I think we started to see that yesterday, hence some of the big names, had some really, really big down moves. But I suspect we're going to see more of that. Why? Well, because this sort of a VIX doesn't just stop. Okay, we don't just, typically how the VIX has always turned around the last couple of years is we get these sort of spikes. Okay, these one-day events where we get the sudden spike and then all of a sudden that typically signals out an end of the move. And we can see the same thing in August last year. There was, of course, the slowdown concerns. And we'll talk a lot about that today because I think that's a similar pattern to what I expect to see, not just in VIX, but in Euro as well as the equity markets. Okay, what do we mean? Well, how this VIX, I suspect, does resolve itself is at some point we're going to get the spike. Okay, at some point we're going to get that real escalation to the upside, that real panicky liquidation move in a number of the equity markets. And I think at that point we may form a bottom. Does it come today? Perhaps. Does it come tomorrow? Perhaps. I don't know. The point is the VIX is not going to suddenly start selling off today, not with where sentiment is, and not until we get some sort of a spike. Okay, so keep that in mind. You don't want to be providing liquidity in these markets because you're going going to get your fingers burnt. Right, now, what is ultimately causing this? Well, I'm going to go through this briefly. You can read up about this yourself. But in essence, we now have got tariffs imposed on Canada and Mexico, as well as, of course, China. China has retaliated, and so has Canada. But the key takeaway is both countries, okay, both countries have really retaliated in a limited way. Okay, and this is important. This is why the markets are not yet panicking. We can see the Canadian dollar is only down 0.3 today, and on the week it's only down 0.24. Okay, this is hardly showcasing a situation in which there's concern. Why is this? Well, there's two reasons. One, Canada's retaliation suggests that there are still ongoing discussions, ongoing negotiations in hope that Trump pulls back, in hope that Trump says, hey, let's give it another month. Now, will that come today? Possibly. Okay, I think headline news is going to be very much in play. We could see Trump come out today and say, hey, I'm going to have a call with Trudeau today, or I'm going to have a call with the Mexican president, and maybe we can bang something up. It's very possible. But if we don't get that, okay, if we don't get those calls today, if we don't get that we're willing to review type messaging today, the markets still need to put on these trades. Okay, they still are not convinced that these tariffs are going to be implemented for any a long period of time. Okay, there's very much this belief out there that Trump is bluffing. Why? Because that's been his playbook, not just in his first presidency, but also currently in his second presidency. Now, this came from one of our traders today on the floor, and I think this is quite a fair point, and I think it's a very valid point that he's made. And what he's saying is, I'd argue and think it's more so the market is still in disbelief, okay? It thinks there'll be a last-minute deal like last time, and that, I think, is absolutely relevant. I think it's a combination of the retaliatory measures from China and Canada suggest that there's still some discussions that are going on, and at the same time, the market wants to wait for those discussions to happen before they actually put on those hedges, okay? So today is very much a day where one of two things can happen. We either get a positive outcome where, hey, okay, we'll give you another month and we'll pause for now, or we get nothing, and all of a sudden the market has to now get to work in repricing and putting on all these hedges. Okay, I think that's how today plays out. I think you're going to get either a very aggressive reversal of some of those tariff moves yesterday, or you're going to get the opposite, which is a very aggressive repricing in the opposite direction. Now, one of those markets to pay very close attention to is the dollar. Why? Because we've been talking about this dollar theme for some time now, and over the last 2 weeks, we've seen this sort of continued pressure to the downside in the dollar. We would have expected this support to hold. We would have expected dollar to not just, you could see it started to stage a rally last week. We would have expected that to continue this week. In actual fact, that literally just rolled off yesterday and is now back at those weekly lows. Now, what that means is that we have still got the entire Wall Street and the open interest, very long United States dollars. I suspect that trade's going to come unstuck. We've been talking about that for the number of weeks now, getting ready for that play. I suspect it happens today. I think the dollar index is going to stage a move down to that 104.50, and I wouldn't be surprised if we have a liquidation event through there. Okay, if everyone's long dollar and all of a sudden the long dollar trade comes unstuck, there's absolutely no reason to be long dollar. All those hedges are going to get unstuck today. So keep a close eye on the dollar. Again, not a market you want to be buying in the near term. It is very much a market that is at risk of a very significant repricing event. Now, what's ultimately driving this thesis of a weaker dollar? We can see it there. That is the Fed Fund futures. It's the expectation of rate cuts over the course of this year. And you can see that we really did have, since September, a squashing out of those rate cuts. And all of a sudden now, with this growth scare, we can see they are starting to put those rate cuts back on. Okay. Now, if ECB and BOE are all talking about, pausing and less rate cuts, and all of a sudden now the market's saying more rate cuts from the Fed, what that ultimately means is that divergence is starting to switch in the opposite direction. Now, where do we play this? Where's the easy money to be made today against the dollar? Again, the way we look at this is go look at the grid. Always buy relative strength. And we can see the risk-off currencies are actually the ones that are doing the best against the dollar. Call it Swiss, call it Japanese yen. That's where you want to pay attention. If that move happens at a time when the equities are offering, i.e. VIX bidding and equities offering, then yen and Swiss franc are going to be your best bang for buck. We can see it very early doors. They are the best performers so far today. And so that is that general sort of risk-off theme. So if there's going to be a dollar liquidation event, Swiss franc, Japanese yen, that's where you're going to get rewarded the most. Thereafter, of course, we can see the euro is the third best performer, and then behind that, the pound. Okay, they will all, of course, go bid up against the dollar, but you want to pick the one that's going to give you the best bang for buck. Why? Because then we can leverage the position. Okay, now let's turn our attention and look at the euro. I think this is a market we've been talking about a lot. Structurally, this looks sexy as can be. Pretty much 105.30 should trade through today, and we should see a number of shorts unlock up there. Where do we stop? Ugh, anyone's guess. I would not be putting fancy lines on your charts trying to look for resistance. This market is now switched. Very, very important. If you look at that part of the chart and you compare it to that part of the chart, note the blue line. The blue line versus the red line is just showing us rate cut expectations from Fed versus the ECB. Now you can see last year when we had the little growth slowdown in the US, what do we see? Lots of Fed cuts, not many ECB cuts. What did the euro dollar do? It staged that move from 108 to 112 in a space of 1 month. Okay, note the divergence. Fed rate cuts being priced, no ECB cuts being priced. We're about to stage that rally. Now, 106.50 is not where you want to be selling. You want to let that market come back into this range. It spent the whole of last year somewhere around that 108.5. That is where I suspect we're going to get to in very, very near term. We're talking about 300 pips to the upside, and I suspect that does come as soon as today. Now, turning our attention more to the bonds, I think the bonds are very much telling us what's going on here. We can see in the 2-year that over the course of the last 2 weeks, we have repriced now almost 45 basis points. That is quite a significant move. This is not going to stop anytime soon. I suspect this will continue to drift path of least resistance back down to that support of 360. But what I want you to pay attention to is, again, it's that Fed Fund futures. Okay, we can see that over the course of the last couple of sessions, the markets are very much pricing in some more rate cuts coming from the Fed. And this is where you want to pay attention to, because if you look a little bit deeper into the Fed Fund futures, okay, this is the June contract and this is the DEC contract. Sorry, that says DEC. Okay, what you can see is that we've only done around 6 basis points in the last 3 sessions. Okay, these are all daily candles in June. In other words, the market is pricing in more rate cuts from the Fed, but it's doing it in the second half of this year. Now, again, this is why I'm leaning on this idea that I think what we're going to see today/tomorrow is perhaps the market bring forward this idea of a rate cut into perhaps as soon as March. Okay, it wouldn't shock me that if we do get continued volatility, particularly in the bond space over the course of the next couple of sessions, we are going to suddenly start to see the market move that pricing into the front end of the Fed Fund futures. Okay, so think rate cuts coming in perhaps March or of course the June meeting. Okay, we of course have got a May meeting, but that doesn't align with the recent dot plot. So March, June, I think that's where we're going to start to see some pricing of a rate cut. Now, if that happens, if we do start to see suddenly the market prices in rate cuts sooner than expected, okay, then we are going to get some significant sell side pressure in, of course, the dollar instruments. Okay, keep a very close eye on that June contract. If you suddenly start to see the market moving those rate cuts in the front end of the curve, all right, that's telling you the market's starting to be a little bit panicked. We're starting to see a little bit of a recessionary type concern. What will happen then? Well, you'll see dollar get hit. You'll of course see the equities get sold very, very aggressively. Okay, now why do I think this happens today? Well, with the VIX at 22, I suspect VIX goes up today. At the same time, what you're going to see is the market's going to put those rate cut bets on the March meeting, and at the same time, you're going to see the dollar get sold. Okay, it is a crescendo of confluence happening today, so buckle up. It's going to be a very, very lively session. Okay, let's wrap it up then. There's a lot going on, guys. I think the key takeaway is that vol is high. You've got to take advantage of these opportunities because this is where we do make our money as day traders. If there are any other questions, of course, do post in the Discord channels. That's what they're there for. Keep a close eye on my channel as well as Daniel Flo channel. There's some good commentary going on there. If there are any other questions, good luck. Let me know if you've got any questions. Otherwise, make sure you manage that risk today. Good luck out there. Go make some money.